Hello and a warm welcome to Econoday Unplugged on Tuesday, the 11th of May 2021. Mark Pender stateside, and I'm Jeremy Hawkins in London. Despite India's COVID crisis ensuring that globally new cases continue to scale new peaks, commodity prices are still flying as investors anticipate a faster response by aggregate demand to accelerating COVID vaccine rollouts than by world output. Copper, iron ore, and steel prices are all at or close to all-time highs as we record this podcast. Market-based measures of expected inflation are moving quite steadily higher for a while now. Demand for inflation-protected securities has climbed sharply, and even the equity markets are starting to look a little nervous. But and of course, it's a big but. Most central banks, including the Fed, the European Central Bank, Bank of England, and the Bank of Canada, still maintain that any pickup in consumer price inflation will be only temporary and essentially attributable to one-off factors. In other words, of no immediate consequence to policy. And the battle between the two sides looks likely to escalate over the coming months as, even if only for technical reasons, inflation continues to move up. All of which makes Wednesday's US April CPI take on even greater significance. But Mark, just before we get into Wednesday's inflation update, looking back at last Friday's employment situation, given all the current focus on prices, which is the more important, a much weaker than expected April non-farm payroll, in fact, one of the biggest market misses on record, or a sharp increase in average earnings growth, which was itself miles above the market consensus?
Well, fundamentally, the former, the level of payroll growth, because that will determine the wages, and the idea being to stimulate payroll growth, you give higher wages. So, but there was improvement on the average hourly earnings. It came in at 0.3 on the year, not very much, but that's well above what the consensus was. But the prior was 4.2% because that was for the month of March, which really gets me to the crux of everything, which is by what comparison? Is central banks are using this annual comparison, which is a prevalent comparison for the global understanding of the CPI or consumer prices. Here in the U.S., it's a more monthly gauge. And when you go month to month, you discard all these issues from this time last year. And even though that the Fed's target is expressed in an annual term, 2%, what does that come out to per month? To 0.2, 0.3, and so those are the levels we need to look at, not the annual level, because these are skewed. And this time last year, if you look at any of the data, the year on year are going through the roof. You did Italian industrial production this morning, right? It looked flat month to month. I can't remember what it was, but the graph is shooting off year on year.
A mere 37.7% on the year.
Right. So it looks really
without actually falling 0.1.
Right. It's actually kind of flat, and then but on this basis of this gauge that is being used, and that's the same kind of year on year gauge that. For the general public and for the general understanding of monetary policy, which is what the Fed is trying to communicate, they've latched themselves onto something that's going to be very choppy, which is going to be going straight up, only because this time last year it was in lockdown, and that's very bad for prices.
Can I interrupt you on that? One of the sort of focal points over here, well, there's certainly something I think we try to when we're writing up these things, is it's easier for the real economy than perhaps for prices, but to compare the latest numbers with where we were before lockdown. So obviously it's quite easy from like retail sales or industrial production, even though we may be talking about March this year, to compare it with February of last year, because that was before we saw the big COVID hit. But I wonder if it might also be an idea, to compare, let's say, March or April consumer prices with where we stood in February last year. Because again, although you've got to decompound it, discount it to 12 months, because it'll be 14 months. But at least then you're comparing with some kind of more natural equilibrium type value.
Exactly. And that would be a great idea. And that's something that we have to do ourselves. Occasionally here in the U.S., the Bureau of Economic Analysis or the Bureau of Labor Statistics may provide it's a simple calculation. You go find what the index, the latest revised index was in February last year, and you compare it with the one you just got. But that's not always presented in the text. What I'm trying to say is that for the public, that might not be something that is going to be, generally aware of. It was kind of interesting. We just kind of have gone through this spell, which was the year-on-year comparisons, and a lot of this data was doing that for us. When it was in February, we got a pre-pandemic and post-pandemic calculations all done for us by the statistics institutes, and that essentially was that. And I guess we're definitely continuing to compare it, especially on the GDP measures, to see when is this gap closed. And it looks like, or when the Labor Department, in the U.S. labor, we were still short, 7-8 million jobs. So when that eventually is recovered, that will be a big headline, and that comparison will be 21, 22, whatever, compared to February 2020.
So, all right then, what is expected for the inflation number this week?
The Econo Days consensus, and I'm just going to talk right now about the month-on-month, is overall 0.2%, which is not a very significant. That's not going to get much inflation traction, and a 0.3 for the core, which is a kind of a moderate to strong reading. Now, both of these readings at 0.6 for overall, that reflects an energy, skewed by energy. And if you exclude food and energy for the core, you came up with 0.3 last time, and that was above expectations. So they both beat expectations last time around. And if they do that again, that'll feed this inflationary concern. Now, the year-on-year is through the roof, 3.6%. Wow, they're already a point and a half above target. Well, that's going to come and go as these comparisons shift. And then the core is 2.3, which is a really nice, perfect level that they would want. A little bit of an overshoot, the 0.3 overshoot that they could extend, but that's because of a comparison issue. And that would be up 0.7 from the March year-on-year. So you can see that these things are just flying all over the place. That's why the month-on-month is what's so important. But the problem with central bank communication is they haven't directed the Fed has virtually no dialogue directed at this monthly issue. So they're going to come onto it, they're going to stumble over their words, they're not going to be able to communicate this in a skilled fashion. So there might be a little bit of haze and confusion that can feed this, I don't want to call it misinformation, but this skewed view of inflation.
Okay. Let me ask you, how much attention you think they pay to all these various surveys? And I mentioned that, or raised a question, because I think, was it last week, I think it was, we had the New York Fed consumer survey, and that found inflationary expectations for the consumer sector for the 1 year period rising up to about 3.4%, if I remember rightly, which is an 8-year high. Does that concern the Fed, the fact it's as high as that, or is this just something they take on board and think, well, that's showing that, but the actual inflation number is really nothing to worry about?
Well, that's a question that we base in our focus on our own customers. We're looking for economic data that we can include. It's difficult to include this into our systems and to cover new data, but if it's something that's being talked about quite a bit. Now, this time last year, Jerome Powell was talking about high frequency data coming in part from the New York Fed, where you measure things like phone calls and credit card things. This has always been going on in the background for the last 20 years to one extent or another. But he was and they never really have correlated well to the actual data. But the data itself is, structured, something like the employment report's been going on for 60 years. And it's measuring labor in its own way. And that is how the perception of the labor market has formed in the market. So you take someone like ADP, it's measuring it perhaps in a better way, but its findings aren't it's the structure itself that helps determine what these numbers are, and these numbers are accepted as fact. I don't know if I'm explaining this very well, but in any case, high frequency data is coming out right now. I've just seen it right from the Bureau of Economic Analysis this morning. Funny you should say this. On credit card payments, and they're talking about Increased policymakers' need for more frequent and timely economic data. In response, BEA is presenting 3 estimates using daily payment card data to measure the effects of the pandemic. So here we go. So there, the BEA, which is like, Bureau of Economic Analysis, they produced the GDP report, and they're coming in with their own set of high frequency data. Now, and when people ask Powell at these press conferences like this last one, he knew the Atlanta Fed puts out a business inflation's expectations report. Went up 1/10 to 2.8, 2.7, whatever it was. But this is the highest in all available records, right? And the Atlanta Fed downplayed it. Was kind of silly, but it is the all-time highest, and he knew it. He knew, it was back in 2014 when it was that close or something like that. So he knows. He's being informed, he's being briefed on all these things. If he's not Powell offering it to the public as evidence for policy. But again, it's very narrow, it's very cherry picking what he's doing, And but in any case, we've been watching these things and closely and how they correlate, and especially if forecasters or economists start predicting this material, that's when it really reaches a pitch that it's not close to yet. It's hard information assembled in a different methodology that is really in the anecdotal category for us.
Fair point, and it's got to be said. I mean, the higher is the frequency, the greater is going to be the so-called statistical white noise in these numbers, because they're virtually impossible to seasonally adjust, and comparing one month with another really doesn't necessarily tell you anything whatsoever. Okay.
And that's what happened with this last jobs report, if I may. We had right at the end, it was going off, it was going nuts. The forecasters were pushing it up high. The high was 2.1 million. It came in like a tenth of that.
Sorry, that's what you're calling me.
It was because of these high frequency indicators at this time. This was part of what was going on, and as well as the legitimate ones or the established ones like. Jobless claims or the employment readings in the consumer confidence report, or the ISM's employment data. Those kinds of things are kind of the traditional. But it went off the scale last week, and we were ratcheting up our estimates. And like you say, I don't know if it was for the record what it was, but it was a memorable miss. And there's a lot of economists with not feeling so great about their. Now, the thing is, next week or next month, if it does come out 2 million, no one's going to remember that they were right, right? So it's a difficult game. That's why we concentrated Econodate on the initial unrevised. Our database is keyed on the initial unrevised data, and that can be used to measure the market effects, as opposed to revised data where it's all blurred out. You can't really see where the markets had reacted to it.
Good point. Well said. Okay, well, I guess one of the implications as far as the currency market's concerned is the fact that the Fed's been, let's be honest, pretty successful, despite talking about rising expectations for inflation stateside. They've been remarkably successful in keeping bond yields down over the course of the last month or so, to the extent that if we look at what's been happening to the bond spread between the US T-note and its equivalent, the German 10-year Bund, well, we've actually seen that now fall, or narrow, I should say, by the best part of 20 basis points since the start of April. And that's partly due to slightly lower US yields, but also due to a fairly sharp increase, particularly in the course of the last week or so, in German yields. And if there's something which does still stand in the world of economics, or at least financial markets, it's the correlation between the euro and the dollar and what's happening to US yields versus German yields. And so the narrowing that spread has given the euro a fairly significant leg up now. As we record this podcast, we're trading at about $1.2165 at the moment, and that's about a 4 percentage point so gain since the end of March time. Excuse me. Appropriate enough when US yields pretty well topped out, and that's going to give some real problems, I think, as far as the ECB is concerned. Now, in the context of inflation where we came into this podcast, the ECB's chief economist, Philip Lane, was last week very much emphasizing the fact that despite some global mounting inflation pressures, he still says that inflation is not coming back on a lasting basis as far as the Eurozone is concerned. It's all due to, a reaction to last year's virus-induced shock, and still maintains that the job market has a considerable amount of slack in it. So really not too different, I guess, from what the Federal Reserve is saying. But it does mean it highlights the fact that they're not concerned about inflation, so they're not going to want to see longer dated yields across the Eurozone moving higher, because if you take a stronger euro and higher longer dated borrowing costs, that is equal, as far as the ECB is concerned, with a marked deterioration in financing conditions. Excuse me. And their policy, of course, at the moment is built around this idea they want to maintain favourable financing conditions for the private sector. So it's going to be interesting to see what this actually means for ECB policy. Now, they announced, as I suspect people remember, not so very long ago, that they'd be increasing up their asset purchases under the PEP, their Pandemic Emergency Purchase Programme, in order to put a lid on longer dated sovereign debt yields across the Eurozone. Well, they may have done a little bit of that so far. The weekly data suggests they've certainly done something towards that end, but it looks on the basis of what's happening at the moment that they may have to do a good deal more. And if we don't see that, there's got to be a chance we can see this euro actually continue to climb against the dollar if the Fed continues to maintain that inflation there is not going to be a problem. So I think that's certainly going to be something to keep an eye on.
Did you see the comments yesterday from the Finnish? I think he's Finnish. Olli Rehn, he's the ECB council member. He was quoted, I think, in the FT, and it was about taking the ECB might want to consider adopting the average inflation overshoot, because their own system, I read it, it wasn't really clear exactly what the point was really, but I think the point was that whatever the ECB has been doing, it hasn't been helping, and that it would be perfectly okay if they switched to something, I guess, more flexible. I don't know.
Yeah, I think that's a fair point. I think it comes down to that because, I mean, people have probably forgotten by now, but the ECB is still undertaking this sort of wholesale structural review of what ECB monetary policy is supposed to be standing for. And there have been a number of proponents suggesting, well, look, rather than having this supposedly symmetric target, this strange near 2% target that they have for their measure of inflation, they should come out and accommodate the fact that they've been missing the target for so long now by going down the Fed's route of saying, well, look, let's have an average inflation rate that then would allow prices to move above the precise target level to try and make up for the shortfalls we've seen in previous years. So I think that is something which is very much being discussed within the executive committee at the moment. And it does look, well, I guess, increasingly likely that we're going to see something like that coming out. Certainly this near 2%, just below, but not actually 2%, as they call it, is a very sort of, strange definition of what they regard as being, price stability in the first place. And it does seem that that's going to have to change at some point. But it will be interesting whether or not they actually go further along the lines of making a more wholesale change to monetary policy. Although, of course, under the ECB's remit, it's actually charged with meeting price stability in the first place. So it's going to be difficult to see them make any significant changes. But this idea of average price or average inflation targeting does seem to be becoming more and more popular amongst a number of central banks, given the failure to meet their targets over the last several years.
Does the ECB have the same kind of freedom that the Fed has, apart from legalities, that they can change such things without?
They can't actually change the target itself. That's given to them. So that's that comes down in their statutes. So that would actually have to be changed by, I think it's European Parliament, in order to actually change that. How they get to it, of course, and how they interpret it is pretty much down to the ECB. But a bit like the Bank of England, the 2% target we have in over here is given to the Bank of England by the Treasury.
I have a question about the Bank of England now. Did they or did they not tighten policy last week?
Now, that is a very good question. The honest answer is no. Although, of course, as soon as you see anything to do with the word tapering, everyone starts jumping up and down, or at least the media do. So, just quickly to summarise, last week, as we talked about on the podcast, the Bank of England came out and reduced its weekly asset purchases as part of its quantitative easing programme from about 4.4 billion sterling a week by about 1 billion down to 3.4 billion. Now, taken at face value, that would sound like, well, hang about, they're spending, or they're purchasing, I should say, 1 billion less of bonds every week. Therefore, they're providing less QE. So that clearly amounts to a tapering. And purely on that basis, yes, they did. However, crucially, as far as the Bank of England's concerned, they operate with a view to attaining a specific QE stock target. And prior to last week's announcement, the target stock of quantitative easing was 895 billion sterling. That was unchanged. And the only reason they introduced this tapering was because the stock target was supposed to be achieved at the end of the year, so at least in December anyway. But on their previous purchase rate, which was say this 4.4 billion pounds a week, they're going to reach it, well, certainly before September time, potentially around about middle of August, something like that. So all they've done is just to smooth out the period or lengthen a period, how long it takes to reach this stock target as they originally envisaged, which is the end of this year. So you can say, well, yes, they have tapered their weekly purchases, but the overall purchase program remains unchanged.
How did the markets react? Did they see? How did the bond markets see it?
I think on the whole, the bond markets have half discounted it. Was the expectation that they would have to do something with their weekly purchase at some point. It might not have been last week. They might have decided to lay it until we got to the next meeting, in June the 24th. But then that would involve a much larger reduction of weekly purchases if they're going to maintain this year-end target. But by and large, I think the markets kind of took it on the chin and said, well, as the bank itself went out to point out, this is not a change in monetary policy. It's just really down to technical issues.
Well, that's the other question: is how did they communicate it? Was it part of the structure of their text or their amendments or their footnotes to the text, or was it how was that imparted to bond traders?
You had to dig around for it because the main body of the text just simply came out and said they're adhering to their 895 billion target for quantitative easing, split between gilts and corporate bonds, blah, 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 no change in interest rates and what the voting pattern was like. You actually had to go through into the entrails of the minutes to find out exactly what they'd been doing. So I must say they didn't make it overly obvious, to be perfectly honest. And I think there wasn't really much market reaction anyway. But it certainly, you had to dig around, and I thought they might have tried. Well, okay, let's rewind. Perhaps one reason why they didn't put it into the official communique was that they didn't want to make too much of a big deal about it. It was, after all, one of these technical factors, and so if you simply want to know, has policy been tightened or made less loose or not? No, it hasn't. So it doesn't really.
But there wasn't a
matter.
little parentheses or anything saying this is entirely a technical move, no policy significance.
Once you got into the details of it, yes, you did get that.
You did, okay.
But there you go.
What is the press conferences like, or that level of communications for the BOE? What's their what's their style?
Well, I guess it's not too different from those you'd have with the FOMC. So, whereas you had Jerome Powell answering questions, the Bank of England with their governor, Andrew Bailey, normally the couple of cohorts from the bank's MPC will answer questions from the press in exactly the same way as Jerome Powell might do. And it's a question of how much or how little they can get away with saying during the course of the meeting. But while you asked about how markets reacted, one reason perhaps why they didn't react, although I don't think they needed to anyway, was because what was going on with the politics. And I should just mention this more with a longer term view, with perhaps immediate what's going to happen there. But the Scottish elections, which we touched on the podcast last week, results of those were it's kind of no man's land. So the Scottish nationalists who want independence, so Scotland to be their own state in their own right, they didn't quite manage to get the outright majority that some people thought they would do. But if you add together all the pro-independence bloc votes, they do still have a majority in the Scottish Parliament. So what does that mean? Well, it means, from what the First Minister, their Prime Minister, Nicola Sturgeon, is saying, that the idea of a second independence referendum is not on the table as far as the rest of this year's concerned, but she will be pushing for it, well, at some point, presumably from the beginning of next year. Now, so this is very much the big question mark, I think, longer term, what it means for the pound. Firstly, clearly, if Scotland were to achieve independence, it's going to be a negative for the pound initially, I think, simply because you're losing 7.5% of UK GDP. There'll be concerns that perhaps Northern Ireland and or Wales will want to go down the same route, and just for sheer uncertainty surrounding the thing. The fact that the pound actually appreciated a little bit last week on the news that the SNP didn't have a majority, I think is testimony to the fact that people were relieved that, okay, that reduces the likelihood of a referendum. But it does look like the Scottish National Party are going to push for a referendum. Then it comes down to the case of whether or not they can actually hold a referendum without agreement from the English Parliament, well, the UK Parliament, I should say, in Westminster. And that at the moment still isn't completely clear. If they can do it, then of course it comes down to which way are the Scots going to vote. And the opinion polls, which were, well, the latest ones in the run up to last week's election, literally were pretty running at 50-50. So I think, for the rest of this year, probably Scottish politics isn't a big issue. But once we get into 2022, when we're going to get many more headlines about Scottish referenda, that could well be, when we get back to the old pre-Brexit style trading, when if the opinion poll goes one way, it's good or bad for sterling, and vice versa if it goes the other way.
Well, that Sturgeon made a really good point about even the courts even trying to make a ruling on this, because that would be an expression against, or even weighing the possibility as some kind of resistance against democracy, which is kind of an interesting. I thought that was a pretty powerful.
Yeah, it's going to be. It is. I mean, it's a bit of a political quagmire, and good luck to anyone.
But it's interesting. Also, I know this has finally dawned on me, and I may have repeating myself, but the cat's out of the bag. The UK wanted to leave Europe, and now as some kind of separateness, and now that separateness is within the UK itself. To me, it's a logical, almost you could call it, I don't know, a predictable sequence. I don't know. What do you think?
Well, in some ways it is, because Scotland voted very clearly to stay in the European Union.
That was before Brexit, but that was before Brexit.
Well, that's it. But one reason why now they want to divorce from the rest of the UK is because the rest of the UK voted to leave the European Union and Scotland didn't. The only way Scotland can therefore get back into the European Union, which is exactly what Sturgeon wants to do, is by pulling itself out of the UK and then joining the EU. Although the technicalities of that really are extremely messy. But it's a bit like the rest of the EU in some ways. At the end of the day, different nationalities want to do their own things. And you only want to do the same as everybody else if it actually fits in with what you want to do in the first place. Right, from my side, before we go on for too long, let me just quickly mention, where are we? In Canada. Canada last week, in line with the States, they had a surprisingly weak employment report. As we talked about in previous weeks, the Canadian economic data have been typically surprisingly good. And their economic consensus divergence index has been in positive data, or positive territory, I should say. So surprisingly strong for some considerable while. But the payroll came in at down 207,000, which is a big decline for Canada. And it's got people now thinking, well, hang about, perhaps this acceleration of the COVID issue out there is going to start slowing down the Canadian economy. So that's now reduced talk of BOC tapering to some extent. But, as Mark was talking about earlier on about, you've got to put all these numbers in context at the moment. And although it was down 207,000 employment as far as April is concerned, that came after a 562,000 increase in February and March taken together. So the underlying trend there at the moment still remains extremely strong. And I think when you're looking at the impact of tapering, one issue that the central bank, the BOC, now has is the fact that the Canadian dollar is extremely strong against the US dollar. And they're getting concerned about what that's going to do to their trade flows, given the importance of the US marketplace for Canadian exporters. But
I don't have that. Where is the Canadian dollar right now?
Canadian dollar, we look at US Canada, so Canadian dollars per US dollar, we're currently trading at just over 121, 1.21 cents. And you think about for most of last year, you were trading 130 plus. So it's been a big appreciation over the course of the last couple of weeks or so. Really, I mean, it was appreciating before we had the tapering announcement at the back end of last month, but nonetheless, that's given it an extra kick.
Now, is the BOC, is the Bank of Canada, are they tapering yet?
Well, yeah, they tapered, say,
they tapered earlier. That's right.
Yeah, they tapered at the end of last month, and that is saying it just shows how sensitive markets are to the idea of tapering. And of course, so long as we still have Jerome Powell and co. talking about interest rates, probably not going up until 2024, the Bank of Canada has intimated it doesn't expect a change in interest rates, but only until 2022. So in theory, we could see, we take them at face value, and obviously they change these things every week like everybody else does. But we could actually see an outright increase in Canadian interest rates, official interest rates next year. Whereas if we believe the FOMC, that's going to be well before the Fed moves.
What did I see? I saw something somewhere. It's this creeping rise in official forecasts, and I saw something that whatever it was moved from full recovery from 22 to 21, and that kind of, I'm not sure what region or what economy. It's just something that flew by me, but that has been, I think that you're right, the Fed hasn't budged yet, but in yesterday or last week's employment report, that's not going to point to that kind of movement. But that was part of what was going on going into that employment report, and what we've been seeing in the Econoday's consensus divergence index is this underestimation of economic data. How is our indexes? How are they doing right now?
Well, it's interesting. So you talk, it's right, and I think it was right. The ECDR was sort of kind of correctly calling or pointing out the fact that market forecasters were typically underestimating what was happening in the first quarter economy. So, okay, stateside, obviously, you're growing well out there anyway. But even within Europe, where the numbers were bad and we got another contraction, the contraction was nothing like as steep as markets already been anticipating. I think on the back of that, we've seen forecasters now thinking, hang about, we were caught out there. Well, now the vaccine rollout is accelerating. Growth is going to come back with a boom. So what, if anything, we're kind of starting to see is that the ECDIs are beginning to move down a bit, and we've actually got some in negative territory now, whereby the forecasters, as they often do, they're turning points too late. They've now gone too optimistic about recovery, having been, too negative on the downside previously. So I think we're kind of in a kind of flux position at the moment, whereby, again, and you can't blame forecasts when you're looking at some of these numbers, which really are all over the place. But I think, people are trying to get a handle on, well, we appear to be, globally almost now, Latin America, perhaps in India aside, we appear to be in recovery mode, but no one's really certain just how fast this recovery is going to be.
What do you think is going to happen to Indian economic data? Are we going to have gaps in our database?
That's a good question. I suppose if we look what's happened in the past, and you talk about, I mean, it really is a sorry story out there, clearly, with almost record cases being reported, pretty well every day. It's reasonable, I guess, to assume that we're going to have some gaps in the data coming up over the course of the next few months, because something clearly has to happen out there. I assume there must be some additional lockdowns and things like that, which just simply prevent the data being collected or put out in the first place. Okay, right. Too long, methinks, probably. Anything else from your side?
No, we're good.
All right. Excellent. Okay, then. Well, let's wrap it up there. So on behalf of Mark and myself, thanks as ever for listening. Podcast will be back next week. And in the meantime, as you all know, of course, you can keep up to date with all the key market moving data and events listed and analysed in Econoday's global economic calendar. We'll see you next time. Bye for now.